Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today we're going to cover the EIA data and provide an update for the Biden administration executive order and what does that mean and how has that changed over the last couple of days as we've gotten a bit more detail. The first section we're going to go through the just a high-level view because we did get a big draw. What caused that? Is that something that's going to remain, or are we going to see a snapback next week? And these are things that we're going to talk about. Segment 2 is going to be a deeper dive into really refined products. Where's the demand? Where's the demand going in the near term, over the medium term? And then what does that mean for imports into the U.S.? And then the third segment is going to look at the international market. Where's the U.S. exports going, and kind of what are some adjustments that we're seeing, especially as some of China slows down a bit. So before we get into that, please like, share, subscribe. Your support is greatly appreciated. It helps us keep this in front of a paywall. So when we're looking at the data, before we go into it, we just want to talk about a little bit about what happened with Biden. And, we talked about the 60-day moratorium or freeze on new permits. But while we've seen that freeze, we've seen some Indian tribes come out saying, look, that we can't go along with this. We want the ability to provide permits. But it wasn't so much the permit side. It was more the right of way, because right now the issue also comes along natural gas hookups and water hookups. So water is obviously a big part of fracking, as you have to push the water down to create that pressure to actually crack the rock or fracture the rock, hence fracking. But the bigger issue is not so much the water, because obviously it's more expensive to take water in, take the saltwater disposal out, but the natural gas hookups. So where are the hookups is going to become a much bigger component, because can I connect on Indian land to some takeaway? And then if I can, then that means that I'm not going to see the same type of restrictions. Now, even though we did have this EO, we have seen new permits get allotted in the Gulf of Mexico. We did get several across 3 different states within the U.S. So right now, it doesn't look like there's going to be a ratchet up of more pressure. It's just setting the base. And the question will remain, is this step 1 of a multi-step process to put more and more pressure on fracturing and U.S. production? Or is this something that is a bit, let's just say, throwing a bone to some of the environmentalists, even though we won't continue down this path. It'll just be something where showing some sign of force, but there will be enough workarounds that we won't see a huge impact into U.S. production. And these are things that we're going to have to continue to look at. Like, Kerry is currently talking about why building gas infrastructure is a problem, because we have a methane issue, and building gas assets mean that we're going to see more methane. These are things where he's always been against more of that bridge fuel. But again, anyone who knows me knows that I don't think natural gas is a bridge fuel. I think it is a part of the solution on the longer term when we look at all of these things in aggregate. And in segment 5 of the Econ show, we're going to go through where is lithium, where are some of these products on lithium ion batteries and some of the clean tech, and we'll see who has the most exposure or controls more of that supply chain, because it's going to become a much bigger commentary when we start talking about China policies and what is that going to look like. So again, this is going to be something to watch. So right now we don't see a huge issue, just like last time. But obviously the water and gas thing that we continue to see, there's some parts, and again, who's going to hurt more? It's going to be the small E&Ps versus the large E&Ps, just given based on size, leverage, and the ability to offset different some of these costs. So again, still going to hurt someone. It's just not going to be the larger entities, and the permits, again, won't be a huge problem, just given the amount of permits that currently are available, as we showed last week. So without, now that we've kind of covered that, we want to look at the crude stock draw. And these are those fun days where there's so many moving parts. What's going to outweigh, where are things going to go in the longer term? So clearly we had a big draw of about 9.9 million barrels. It was driven pretty much all by Pad 2, Pad 3. So Pad 2 had a decline of 2.67, with Cushing a big draw of 2.28. But the biggest came from Pad 3, which was, along the Gulf Coast, of 6.43. Now, the question is going to be, how is this going to continue? Because you can see still on the year-over-year basis, we're still 45 million above year-over-year, still 27.7 above the 5-year average. But is this going to continue? Now, we had some fog issues 2 weeks ago, or 2 weeks ago, which would have impacted last week's numbers. And what was the swing? So the swing is, imports, and we'll go through this in more detail in the next few slides, but imports were down 981,000 barrels a day, mostly driven by Pad 2, Pad 3, and exports were up 1.104, which is all really that Pad 3. So we essentially had a swing of 2.085 million barrels a day leaving and or just not coming into the U.S. So that is a huge drawdown on where things are going into the international market. Now, we've had spreads open up, as we've been talking about, so aggressively, of having to see some of these spreads in order to get more crude into the market. We'll look at European storage and some other storage, but again, this is something where it's a big draw. We had a build, a surprise build last week. We have a bigger than expected draw this week, and we would expect to see a little bit of a reversal now as we have more imports coming in and some of these exports coming back down to normal. Just now that we've passed fog issues and some of the normalcy, but again, still a positive direction overall. Now, crude oil production is down to that 10.9. Again, this is where we've been sitting, and this is where we think we're going to hang out. As we talk about in our Primary Vision Frac Spread show, we've already we're getting to and just over that level to really kind of hold this line here. So this is going to be one to watch as we go through, not really Q4 earnings, and then because that's going to set up what are the E&Ps talking about, where are they hedged for this year, and what are we expecting in terms of production as we go forward. So when we look at crude oil inventory excluding the SPR, we're back now within the cloud, which is a positive. On the worst case, we normally kind of see that rise. We had that unseasonal drop, which is again that positive, or I shouldn't say unseasonal. It's larger than some of these norms, especially when we get some of these increases. So again, we're still flatlining. We're not getting that move down. But we'll have to see, is this more of a structural problem in terms where we'll get the snapback, or is this going to be a continuation? I would say that we're still going to see some positive news. It's just this was an extreme to one side, just given some of the issues that were in the market. And then when we talk about some of these issues, this Pad 3 is starting to normalize. We're right on the cusp. We're still in that seasonally adjusted high, but we're coming back down into this cloud, just given from the export level and the lack of imports into specifically Pad 3. Now, as we've been talking about, as we saw some increases in Pad 3 refinery runs, as we've seen some exports continue to increase, this was going to pull Cushing crude down, which is continuing this case. We thought it was going to be a little bit not this massive move down in terms of just the slope. It was going to be a bit more gradual. But again, there was a big movement to the downside. Not to say that there won't be a big movement to the upside, but it'll be a little bit of an adjustment up. It'll just be a bit more measured to the upside. And really, when we look at it on a 4-week rolling average, is going to be a net positive when we consider where Cushing storage is, especially when we start to think about, okay, well, where is U.S. production going? How is that going to impact, and where are runs going to go over the next few weeks? So when we look at imports, this is where we're getting those numbers. So when we talk about the drop in imports, we see that drop of 981,000 barrels a day. And it was, Pad 1, a drop of 106, Pad 5, an increase of 156. Again, those kind of, net out for the most part. And Pad 5 will continue to see some increases over the next couple of weeks. They have their own logistical issues on the coast. But Pad 2, Pad 3 had some big drop downs, and the question is going to be how quickly are we going to get some of these adjustments. Now, when we look at the 5-year average, obviously we're down a large amount, but when we look at year over year, it's a bit more manageable in terms of where we can get some of these snapbacks. It's one where I think both pads 2 and 3 are going to be in the positive numbers, this week into next week, and we're going to start to see a bit more normalcy at this point now that we're starting to get a little bit more movement on the coast. Where is some of this product going? And just now that we're starting to kind of flatten out on this refinery throughput side. So when we look at crude runs, speaking to refinery throughput, as we were talking about, Pad 3 had the increase of about 109,000 barrels a day. But we had some declines in some other regions, again, dropping us on a total utilization rate by about 0.8%, putting us at about 81.7%. And that's what we were talking about, where we still expect to be at that about 83% level as we exit January. We'll have some of this coming back. We had some unscheduled downtime. Again, it's just going to be this ebb and flow of plus 1%, minus 0.5%, and we're going to stay within this comfort range just because, again, looking at the demand side, we're just not seeing the same type of demand on the products level. They're trying to manage storage to get some of these prices higher. Gasoline prices continue to push higher overall, which is, again, going to be as hopefully a positive for some of these guys, just because we're seeing the floating barrel continuing to move higher. And, our gasoline is priced off of the last incremental barrel, which is coming from the coast. So, again, these are things that are going to push prices up, especially as we move further into backwardation. So, again, runs, I would expect there's going to be enough good positives to keep us at that, let's call it 82 to 83%, and really not going back into the 70s, just given where some of the spreads are. We've had some cracks recover a bit, and especially for Bonnie. So when we start looking at imports and again, starting to see a little bit more of a movement in as they start to work with some of the blends, Nigeria is starting to, still has some spare cargoes. Some of that could easily start to move into the U.S. markets, just given where some of these spreads are. What is this going to look like going forward? So it's going to be a very interesting next couple of weeks. When we look at implied demand, as we talked about, we had that move down in gasoline. Not really surprising, just given where things are. We still think it shakes out higher when we're looking at this over the next few weeks. Distillate had a nice surge. We talked about that bump up, but again, now we think that this was kind of that last push to normalize some of the diesel market, some of the distillate market with heating oil. Now that we had some cold, now things warm up a tiny bit. So this will pull back some of that distillate demand. Jet fuel still muted. Again, we're just going to waffle between that kind of that 950 to 1.3, and we're just going to kind of work within that level. And it's something within that level that's given based on seasonality, based on where we have been in the past. Propane still remains strong year over year. Had a walk back. Again, this is something that we think is just gonna stay within these elevated ranges, setting those new highs in general. So then when we look at, again, crude oil floating storage ticked up a little bit as we were saying it was going to. And this is why we think that there's going to be that movement from the coast onshore. We have some rates moving up for VLCCs from Saudi Arabia into China, some of them coming into the U.S. Again, not a huge increase, but you're starting to see a little bit of tightness, a little bit of an increase in day rates, which just means that we're having some more come into the U.S. And it's not that we're going to go back to the 5-year average, but at least we're going to continue to hang about. Now, I think we'll probably get enough interest to, we had this little spike, so we won't be really at that. We'll still be below the cloud, but again, moving with in tandem with the bottom of it as we start to see more pull into Pad 3. Now, when we look at imports, this was something that we thought was going to suck along the bottom in terms of that cloud, or really kind of stay within the bottom of it. Instead, we had a big drop to the lowest for 2021 so far. This is going to be a snapback. So that's why when we talk about exports, imports, we always talk about that 4-week rolling average, the importance of looking at this, just because you'll get some surprises to the up and downside based on timing, based on weather, based on, pilot availability, how quickly can they get stuff in and out. So again, this is something that we'll think will snap back. Not that it's going to come too far above the high from last week, but again, it's just going to be within that ebb and flow, tracking along the bottom. Pad 2, we thought that there was going to be a drop along the seasonal norm, but it was going to be a drop back to the 5-year average, not this huge drop to the lows. So again, this is something that's just going to have that snap back up, and it's something that we're going to see live within this that 5-year average once you start to look at it all over the longer term. Just as we have the Midwest and the Mid-Con refiners kind of holding steady in terms of activity in general. So then when we look at that utilization rate, this is where we're back within this cloud. We're kind of moving along the seasonal norms. And again, there's really not much to show that we're going to get a big move up or down. This 81 to 83, we think it'll trend a little bit higher now that we've had some margins, some of the cracks come back a bit. This will support some of that activity, about that 83%, not so much that 81. It'll pull through a bit more crude, but it's also going to pull some more crude off the water. Exports are going to ebb and flow. It's something that we think the exports are going to pare back a bit. Again, we've been expecting that 2.6 to 2.8. We were at 2.2. Now we're at 3.2. That we think it's again going to come back down to that 2.6, 2.8 on the longer term trend, which will be positive to see some of this crude continuing to go into the market, but still won't be enough over the longer term to see and kind of draw some of this crude permanently out of storage. It's just going to be a matter of moving from one tank to another, and it'll just keep seeing some normalcy, but the international market's starting to weaken a bit, so it's going to be interesting to see how that shakes out and how much of our crude continues to move, not only just into Europe, but into Asia over the next few weeks.